Good morning, everyone, and welcome to our sixth webinar in this Banking and Finance webinar series that we've been running. So this week, we're going to be running through a session on priorities in restructuring and insolvency, and giving everyone a bit of a flavour of sort of how the priority structure works in an insolvency scenario and how you can sort of prepare yourself with your clients so that you don't get caught out as they fall into a position of distress. So today, we've got myself. I'm an associate director in the business restructuring team in Sydney. We've got Matt Blum, also an associate director from our Melbourne restructuring team, and Ben Schierhuber from our Cairns restructuring team. Just a bit of housekeeping before we start. If you've been on these webinars before, you're probably familiar with this, but for anyone who's not, if you have any questions, please jump in. There's a little question pane where you can submit your questions and we'll respond. If we have time during the session, we'll get to the questions. If not, we'll get back to you after the webinar if there are any specific queries. If you're struggling with audio or any other technical difficulties, please click the support button and we'll get someone to help you out. And following this session, we'll send an email with the slides, a link to the session, some access to the past webinars and the one coming up, and our contact details if you need to get in touch with us about anything we've covered. So today, as I sort of mentioned briefly, we'll give an overview of sort of priority regime, how it works, both from a sort of theoretical and a practical point of view, and really dive down into circulating assets, as that's where we see sort of the most controversy and risk arising in the priority regime. We'll talk through some PPSR related issues as they relate to the priority regime. And finally, we'll talk through a couple of sort of key industries as we see it, where there are risks around security and the priorities in an insolvency scenario. So without going into a lot of sort of theory on or legislation on what the priority regime looks like, broadly speaking, if you see a company go into insolvency, there's sort of a regime set out in 556 of the Corporations Act, which deals with how the pot of assets are made available to creditors of the company. So I guess we'll break that down into two categories: the circulating assets, which we'll sort of go through in a bit more detail how they're classified, some sort of tricks that sometimes trip people up. But broadly speaking, we're talking about cash, accounts receivable, inventory, those sort of assets. In a voluntary administration, the administrator has a sort of right of indemnity or a lien against the circulating assets for any costs or liabilities that they rack up, and that sort of sits ahead of any circulating asset security and ahead of employee entitlement. So if you see an administrator appointed to the company and they've decided to trade on the business and they're going about sort of incurring liabilities on a daily basis, those liabilities are going to be funded out of the circulating assets of the business. So it's something to be mindful of. You know, if you see on day one of appointment, you know that there's sort of an amount of cash in the bank and there's some debtors coming in. If an administrator is trading on the business, they're potentially dipping into those asset classes to fund the cost of running the business. Now, ordinarily, you would expect the administrator, if they are running the business, to be trying to run it break even. But you know, there are circumstances where it makes sense to trade on a business to achieve a greater outcome, and that might result in incurring trading losses, which are inevitably funded out of circulating assets. Next in line, the VA's remuneration disbursements for undertaking the administration they also have an indemnity out of those circulating assets to pay those fees. Next in line is the priority creditors, so any employees, and there is a sort of separate priority ranking for all the different classes of entitlements, but again, it's something to be mindful of, because in an insolvency scenario, you can end up with some big sort of redundancy and termination claims if the administrator does terminate employees or seek to wind down a business. So that can also eat substantially into the circulating assets. Finally, we then get anyone with their GSA security, the old fixed and floating charge, then comes in, and any surplus of circulating assets falls to them before unsecured creditors. From a non-circulating asset point of view, often more straightforward in that you generally can identify sort of the specific security that relates to. But again, the VA should be discussing with you before they take any action with non-circulating or fixed assets, but their remuneration for preserving and realising those assets will come out of any proceeds from the sale of non-circulating assets. Next in line, if there is any security holders that have specific security, so that would be, for example, companies or financiers that have a charge over a vehicle or a charge over a fixed piece machinery, obviously have a priority to that. Next after that, the GSA security, and then any surplus after that flows down to the employee and unsecured creditors. And so that's a bit of a brief overview of how the regime works from a theoretical point of view. And I mentioned briefly sort of how the costs, the remuneration and costs work. If you're the secured creditor in an insolvency scenario, you should be expecting the administrator or liquidator to be agreeing with you what sort of costs they're looking at up front to deal with the assets that you have security over. If you're not comfortable with what the administrator or liquidator is doing, the secured creditor is entitled under their security to enforce and can appoint their own receiver. Granted, that comes with their own costs, but at least you have your own representative in there. There's no indemnity out of non-circulating assets for trading costs for the administrator, so they're purely relying on the circulating assets. So they get their indemnity out of Section 443D of the Corporations Act, which covers them for all remuneration and costs, and that it's quite a difficult thing to challenge if you're not comfortable with their level of fees. I mean, they have to get remuneration approved by creditors, but if you're sitting there as a secured creditor and they have administrators sort of eating into the circulating assets, it's quite a difficult thing to challenge. So communication is key on this aspect, and as a major stakeholder in any administration or insolvency, the secured creditor should have a right to be across the sort of level of fees that are being incurred. So don't be afraid to ask that question, so you can sort of get comfortable on your security position and where you're going to land. It can often, if the administrator is trading on, it's often quite a substantial cost, particularly if you see them extending the convening period. So for those that don't know, sort of an administration initially is meant to be sort of a short 5-week process, but it's not uncommon in more complex administration for the administrator to apply to court to extend the period of the administration, and that can be for a number of months to allow them to undertake the process in a more sort of diligent time frame. And so with that comes costs, and that indemnity out of the circulating assets continues whilst the administration is on foot. So it's just another sort of issue to be aware of, that if you see an administrator extending the convening period, that that indemnity continues and the cost can continue to rack up. Likewise, a secured creditor also can enforce their security if they're not comfortable with the conduct, or if they want to protect their own position. There is a sort of a decision period for a secured creditor in an administration of 13 business days, but generally speaking, you can seek a notice from the administrator giving you a right to enforce or appoint at any time during the administration, which is something that we often recommend to our clients who are financiers of businesses in administration. I'll hand over to Matt now. He's going to run you through sort of a bit of a case study on how we look at a distribution of assets.
Thanks, Jeff. So this is a case study loosely based on an example of a liquidation recent experience where we had wound down a rural suppliers business, and also then realise the business as a going concern. So this sort of table, some of you may be very familiar with, others not so familiar, but either way, that said, I'll offer our perspective when preparing these tables and our considerations. And then, so before going through how these asset realisations are distributed, I'll firstly talk to the considerations when assessing the asset values, which can be equally as important. And so you can see here in this table, we've divided the asset classes by circulating and non-circulating. As Jeff referred to earlier, it's an important exercise because a financier may receive a greater priority over non-circulating assets ahead of circulating, where those employee entitlements come in first. So it's essentially a reformatted balance sheet that helps us see where's this money going ultimately. So first consideration there, where does the asset sit, who gets first priority, and then it's important to look at what value can we rely on for those assets. So cash at bank, whilst it's often considered the best asset, it's a very fluid asset. So if you've got a client with a healthy cash at bank balance, it may not be as reliable as you think when it comes down to distributing those assets, because they might dissipate those funds prior to funds being recovered by a financier or an appointment. The best way to secure that cash at bank balance is with a formal appointment. So with a voluntary administrator or a liquidator, they'll take instant steps to freeze that balance. So when assessing a client's position progressively, that will naturally fluctuate and may not be altogether reliable. Heading down the page to debtors, in this example, in this specific case that I had, the debtor balance was quite reliable, but in many instances, you don't need to scratch below the surface very far before you start realising that, okay, well, on face value, there's a $1.4 million debtor book, for example, but a lot of those debtors are not collectible for one reason or another. Great starting point is to look at the aging of the receivables there, and is there a large portion above 120 days, and then start questioning the material balances there. And so the debtors, as Jeff mentioned, firstly being distributed to those other priority creditors as before the financier. Stock. Now, when assessing the stock value, it can, again, the face value of that stock balance in the balance sheet may not be altogether reliable. Now, depending on how that stock is ultimately realised, if it's by forced sale and auction, quite often you might be looking at just a fraction of the balance sheet value. In some instances, companies don't run proper stock records in their accounting system, and you might actually just end up with some sort of ambit allocation of a stock balance. In many instances, and it quite often happens when businesses are in financial distress, they might not be running their operations as well as they otherwise would. And so in this specific case of this rural supplier, they had a large amount of stock that were medical goods for livestock, and a lot of those medical goods were actually past their use by date. So with a little bit of due diligence there, you can start saying, well, what's the real value of this stock here that we can rely on? And then depending on how that stock is ultimately realised, it will impact the value you can achieve for that. We were able to sell this business as a going concern, so we achieved pretty much just about full value for the stock, aside from those obsolete goods that weren't saleable. But in many instances, if it's a forced sale closure, and depending on the industry that the customer works in, it can impact on what that stock's realised for. And we'll go through some of the industry risks later. Plant and equipment, this is pretty straightforward. Often there'll be a financier will have a valuation on this in any case. A consideration there would be, can a better outcome be achieved for realising that plant and equipment under a going concern sale, which brings me on to goodwill. Most businesses will have some sort of goodwill balance in their balance sheet. It's pretty common, and that balance just evolves over time. Maybe they've capitalised expenses or purchases, but in a realisation scenario, or what value can you rely on for goodwill? Quite often the case is when we're dealing with these businesses, well, the business is only worth what somebody's willing to pay for it. So a goodwill balance is just a book entry. So until we start seeing how the market reacts to entering a sale campaign, the level of interest, how competitive it is, it's really difficult to start attributing the value to goodwill. And another consideration that we might do when going through this process is creating a high-low scenario where, well, under a good scenario where we've got a going concern sale and based on the way the level of interest is unfolding, it might be that there's a greater realisable value. Whereas, well, in a forced closure scenario, what might that realisable value look like? So there we see, right, well, we've got our asset values, what we think we can rely on, and then attribute that between circulating and non-circulating. Then flying onto the liabilities, and it's a little bit of a waterfall cascading down how these funds flow. I'll start with the easy one. Non-circulating asset will, after lease liabilities, perhaps be distributed straight to the financier, bearing in mind those realisation costs. And then dealing with the more complex of the two columns, our circulating assets. Well, during the realisation process, there could be retention of title creditors that need to be dealt with. Those that aren't familiar with retention of title, it basically means that, say, a trade creditor retains title of the goods until they're paid for. So even though they might hand it over to your customer doesn't own it until it's paid for. Now, this is a bit of a trap for financiers, where they might be assessing a balance sheet, and this liability will actually be sitting in the trade creditor balance, and trade creditors are typically viewed as unsecured creditors, whereas due diligence might be warranted to assess, well, what trade creditors retain title over stock and therefore would receive priority ahead of financiers. They ought to be registering their security interests on the Personal Property Securities Register. That will be a good starting point to check, well, who might these retention of title creditors be? It won't tell you what the balances are or what the balances will be ultimately, but a good start in that due diligence process. And it's something that we're naturally well versed in and experienced in assessing these sorts of claims. In this particular instance, we were able to knock out quite a few of these claims just because they were defective. There were some claims that were quite clear, and we recognised them quickly, and then others were a little bit dodgy. And sometimes a commercial outcome can be the best outcome for everybody involved. Again, coming back to this specific case study, we had a key supplier that if we, during the negotiation process, they also had a bit of leverage, because if we're selling the business, we wanted them to support the ultimate buyer of the business, and if we didn't, if we weren't careful on how we approached that retention of title creditor, then it would have jeopardised the going concern sale. Whizzing through the rest of these, employee entitlements, pretty self-explanatory. Termination entitlements not necessarily ordinarily would not be listed on a balance sheet, so that's another hidden priority perhaps that similar to those retention of title creditors. That might be an example of what Jeff was talking about, where the greater good would be to trade a business and keep it going through to a sale as a going concern. So you might be able to minimise or avoid that termination entitlement liability altogether. PIMS, the PPS leases, self-explanatory. Realisation costs then having priority, again, Jeff discussed that. And in the liquidation scenario, as opposed to a VA, there's pretty well versed case law and universal distributing to the matter, which has evolved over time, and a precedent there. So it's wise to, rather than let that amount just increase over time, but set expectations at the beginning and agree how the matter will be approached to, so you've got a good handle on what those costs are. Then all of a sudden you've got the balances. All right, well, these are our assets split between circulating and non-circulating. Here are the other creditors that receive the first bite of the cherry, and this is then what becomes available to the financier. So this is quite a simplified example. In this case, we achieved a good outcome for the financier, and then distributing funds to normal unsecured creditors. I haven't listed this unsecured creditor balance here, but I think we're about $3 million in normal ordinary unsecured creditors, so they received a return after the financier was paid out. Yeah, so that's a good summary there on how those assets are distributed. It's essentially a more clearer way of presenting a balance sheet and then thinking of the reality of the situation, what can be relied on, what will people actually receive, which matters most at the end of the day.
Thanks, Matt. So just going to move on now to talk about some of the risks and strategies you can employ to protect that circulating asset balance if you do find your customers in a position of distress. So to sort of set the scene, I thought I'd run through, I guess, a fairly common scenario that we see pre any sort of insolvency appointment. But if you think about this scenario, and I would suspect that a lot of you, if not all of you, have probably come across something similar at some point. But you have a borrower who's starting to fall into a position of distress. They might have asked you for more money, and you've said, "Sorry, we can't see you being able to service it, or security doesn't work for us." So they might go out to the market and approach an alternative lender. And there's plenty of them out there at the moment. There's a lot of capital funding. It's pretty cheap at the moment. So new lender might come along and issue a letter of offer to provide, for example, an invoice finance facility, subject to having a sort of first ranking priority over the accounts receivable. In order for that to work, the borrower comes to you and requests a priority deed for the incoming financier to obtain that sort of specific security over the debtors. And in order to sort of sweeten the deal for you to get you across the line, the borrower offers you a portion of the proceeds from the new facility to reduce your debt. So the few sort of considerations and issues in that scenario. The first one being, how do you actually sort of consider what they're offering in terms of consideration and determine whether that's sufficient for the asset that you're effectively going to release to the incoming financier? You have to look at, as I said, it's a circulating asset, so there's, in a worst case scenario, there's a number of other priorities that sit ahead of you in the waterfall. But the flip side is that this new facility might give the client enough working capital and headroom to get back on their feet and start trading profitably, therefore sort of enhancing your other security values. So it's a bit of a fine balance, and there's no sort of right or wrong answer, but there needs to be some sort of science around how you actually value that security that you're going to give away, and determine whether what you're being offered in terms of consideration is sufficient. The main question though is, what is the likely outcome for the business if you don't agree to the request? If they're already sort of falling into a position of distress, you've said no to further funding, they've gone and sourced potential new funding, and that doesn't necessarily tick all the boxes. What happens to the business? And the risk is that it goes down the path of an insolvency appointment, whereby all of a sudden what's on the balance sheet is now reduced to sort of liquidation value, or there's issues with collecting out debtors, realizing maximum value for your for your security. So that is sort of, whilst as a secure creditor you've got rights to certain rights under your security to agree or not to agree to these sort of things. I think that sort of has to be the overarching question as to what is the likely outcome for the business in both scenarios, if we do agree, if we don't agree. More from a sort of, I guess, a community perspective, what is the impact on employees by accepting this? And the reality is, depending on the position the business is in, if this new facility enables them to get back on a stable footing and sort out some legacy issues and continue to trade, then fantastic. It's enabled employees to keep their jobs. If you've taken some consideration off the table, you've reduced your debt to a level that you're comfortable with. But the flip side is, if you allow a new lender to come in and take sort of a specific security over accounts receivable, that's actually converting the circulating asset to a non-circulating and taking it out of the hands of employees. So if it does end up going into an insolvency scenario, this financier has first ranking charge over the accounts receivable, which has a huge impact on the claims of employees who no longer have that asset to settle their claims. So again, it's not necessarily a claim or an issue that affects the financier yourself from a financial perspective, but from a PR type perspective, it is something worth considering. It's also worth doing a bit of diligence around whether the business can actually service new debt, likely at a higher interest rate than what you've currently charging your client. The reality is, if they're going to an alternative lender in a position of distress, they're likely going to be charged, if not double digits, then close to. And there's a question mark over whether the business can actually service that debt if they're already struggling from a cash flow perspective. The other sort of final consideration is, what happens if the customer defaults on this new lender's facility? They might sell it as, this is going to solve their problems, deal with their legacy issues, but what if 3 months down the track, the business actually hasn't turned around at all, it's continued on its sort of downward trajectory, and they default on the new lender's facility? Does the new lender, all of a sudden, who thought they were getting a good deal, is concerned for their position, goes and appoints a receiver over the accounts receivable, or does something that forces the company's hand into appointing an administrator? What impact does that have on you as the main financier and your security position? So it's a number of considerations in this sort of scenario, but we thought it's sort of a good way to set the scene when thinking about circulating assets, as often that's what a company in distress will look to give up. Is that something they can sort of provide a security to an incoming financier that isn't necessarily already under some sort of specific security arrangement? I'll just hand over to Ben now, who'll talk you through some of the other risks that we often see in sort of priority and circulating asset issues.
Yeah, thanks, Jeff. So Matt touched on this briefly earlier. So employee entitlements on termination are very, very rarely going to be recognised on any sort of balance sheet. A lot of the businesses that I see don't even properly accrue employee entitlements on a year-to-year basis. So you can see how, in a situation where cash flows are becoming tighter and tighter, and the business owners become more and more focused on just the operational aspect of trying to get through another day or another week, that calculation of balance sheet liabilities isn't necessarily going to be the highest thing on their radar. So when it comes to these employee entitlements, they can be a real sting in the tail that can ultimately erode what you may consider to be a fairly strong security position. So you've got not just the annual leave, but depending on the relevant award, there might be leave loading on top. So that's another 17% potentially on top of all of the annual leave. Long service leave, that will get enlivened on a pro rata basis for some employees. So just because they don't have a present entitlement to use it, I know certainly where I live up in Queensland, once you cross the 7-year threshold, you're entitled to your pro rata long service leave in the event of a redundancy. So that's another one that often sneaks up and takes on quite a substantial liability balance that you may not have otherwise been expecting. And then there's payment in lieu of notice. That can be, 5 weeks if you've got someone over the age of 45. They've been around for some time, so you only need a couple of those employees to start ratcheting up decent balances. And then you've got redundancy, which that can be 16 weeks if you've been around for quite some time. So you can see how a single employee can be up for multiple months of remuneration in a single hit in the event of an insolvency. And that's all going to be things that, as we touched on earlier, are potential priorities and going to jump ahead of your security. So important to assess that as you're coming in. Cash, again, Matt touched on this. It's great to have, but it's quick to disappear, especially when people are looking right at the end towards appointment time. So I know that we've had an appointment up here where we were nervous about the cash disappearing before we were appointed as VA. So we required $600,000 to be paid into our trust account because we were going to be trading on the business. There were contingencies and contingencies involved. So all of a sudden, if you were the financier looking at the bank account, yep, all right, they've still got it. Yep, okay, they've still got it. Bang, 600 grand just disappears. So fortunately, it came into our hands and we were able to achieve a great result for pretty well everyone. But nonetheless, it demonstrates how quickly cash can go missing and outside of your potential sphere of control. The company dealing in the ordinary course. So when a company ceases to deal in the ordinary course, it just opens up an exposure for a whole bunch of other things. So disposal of assets in the ordinary course, fine. If it's not in the ordinary course, so it's not an inventory item, they're selling bits of machinery or they're selling inventory at absolute fire sale rates, that can leave you in a worse position because all of a sudden those assets are starting to disappear, notwithstanding potential security issues that you'll encounter. But it can also open up claims from liquidator for preferences, antecedent transactions. So they're tools that we can use to try and enlarge that pool of assets to put through that waterfall and hopefully discharge liabilities. But a company that ceases to deal in the ordinary course is always a concern. And then, other companies' processes maximising debtor collections. As I touched on at the start of this, when a company's right towards the end, all sorts of things start breaking down. You'd think that, okay, we're right at the pointy end of our corporate life at the moment, cash flow is really, really tight. You think that focusing on debtors would be a priority, but sometimes it isn't. Sometimes it's purely being on the phones, talking to people all day, and they don't focus on these debtors, or they're so stressed about cash flow that they start compromising debts that were otherwise good and otherwise would be paid, say, at the end of the month. So just another way that your security can become eroded without you necessarily agreeing to it because of the actions of a company that's in distress.
Thanks, Matt. I think over to you.
Just continue. So it'd be remiss for us to talk about priority creditors without mentioning FEG, being the acronym. Those of you who aren't familiar with FEG, I'll just give you the brief backstory there. But that dates back to about 2001, 2002 when Ansett collapsed, and there was a large amount of employees who were owed a large amount of entitlements, and the airline couldn't pay them. So the then Prime Minister John Howard brought in this scheme there where the government would fund those employee entitlements in instances where the company didn't have sufficient means to do so. Now, it's important to note that FEG don't, when paying the employee entitlements, they don't extinguish the liability, but rather they replace the creditor. And the common terminology is that they stand in their shoes. So employees have this redundancy and other entitlement liability, then gets paid by FEG, and then FEG in effect then becomes the creditor with the employee claim. Now, and that's brought about by virtue of Section 560 of the Corporations Act, which, interestingly, FEG is the obvious example of the financier, in effect, that stands in the shoes of employees. There aren't many other financiers that utilise this section of the Act, which is surprising, really, because it can afford them that greater priority, where if they're funding employee entitlements, they can jump the queue. So something perhaps for people on this call to keep in mind. Now, what's evolved over time is that you've got FEG as a very experienced creditor, long-standing across many
liquidations for high value amounts. They've become quite sophisticated. Initially, it was quite an inefficient and slow process, and then over time became quite slick. What then evolves in about, I'd say 2015, 2016, there was a bit of an epidemic, cautious words, but where Phoenix activity became rife. And so those of you who don't know what a Phoenix is, it's basically when a business or assets are transferred out of one company into the next, and the creditors are left behind, like the mythical bird, the Phoenix, who then rises from the ashes. So these related parties continue to have the benefit of these assets, leaving creditors behind. One of those creditors was repetitively FEG, and they basically had enough of that. So what they started doing was funding litigation claims. I think it was in particular these Phoenix business that brought that about, but which is a great thing for the benefit of all creditors, including financiers. But then other issues arise there for financiers, where they are also quite involved with reviewing how costs are allocated between circulating and non-circulating assets. So if you're a financier receiving a distribution out of non-circulating assets, that they may take a differing view from a liquidator on, well, perhaps a greater amount of cost should have come out of that realisation before those funds are paid to a financier. I'm aware of pursuing litigation against the appointees where they've considered that circulating assets were dissipated for the benefit of non-circulating assets or the continued trading of the business. So it's definitely something to be mindful of, and it varies from circumstance to circumstance, but to be mindful of, well, what's the impact of FEG being involved here, and just proactively being mindful of that. I think that's pretty much all that is worth saying about FEG at the moment, but perhaps if there's an upside there could be a lesson learned from what they've been doing well in funding these claims to get a greater return to creditors, and then perhaps where a financier has a shortfall, they might want to turn their minds to, well, how can we perhaps fund a claim and receive a priority distribution from those recoveries. So that's something we're obviously experienced with and can help if any financiers are considering that. That's it.
Thanks, Matt. Just quickly touch on, I know we mentioned, how we sort of classify assets and break them down to work out sort of who receives what priority. And it, on face value, it's sort of simple, but I don't think it's ever, as simple as the table that Matt presented. There's obviously a bit of thought that goes into how we classify an asset, and often there's legal advice we obtain on sort of different issues or complex matters. So the impact of PPSR is obviously a big one, particularly around retention of title and PPS leases and the sort of specific security that gives another party over certain items. The other thing that we often see come up is a right of set off. So you may be providing the debt funding to a company, but their transactional banking may be with another provider. and they might have, you know, some unsecured credit card debt or something like that. So we'll often see you might have, you know, a couple $100,000 in the bank on day one of appointment, and you go to claw those funds back, and you only get a portion of those funds transferred to the administrator, as the transactional bank has sort of rights in their documents to offset for any unsecured debt. So another sort of catch out there. And as we've sort of talked about in the scenario I ran through earlier, the circulating asset on face value can actually be non-circulating. The greatest example there is invoice financing, where a financier has a sort of super priority over the accounts receivable, which even defeats the employee claims. And I think one of the sort of more recent times we've seen quite a high profile one that's popped up was an RCR, Tomlinson. So RCR, the, you know, large listed engineering construction business that went into administration, and they had the issue of how to classify WIP. WIP, I guess, you know, on from a simplistic point of view, is typically, you know, inventory or going to become inventory. But the issue in this was there's different categories of WIP, and to get some clarification, the administrators of RCO went to court and to get judgment on these. So I just sort of run through quickly just to show you sort of an example again of how, you know, the classification of circulating, non-circulating assets is not always clear cut. So category one that they sought clarification from the court on was where works have been completed by RCR prior to their appointment. They're entitled to make a progress claim and invoice, but they hadn't yet done it. So in effect, that's sitting there as finished goods, if you'd like. The court ruled that was considered a circulating asset. The second category was the works were completed, but they were awaiting some sort of certification or approval before they were in a position to issue a progress claim. So in their eyes, sort of construction largely finished, but not yet certified. So similar to category one, but I guess another step back in that they weren't able to issue an invoice yet. Court found that was also a circulating asset. The third one, which is probably the most interesting category here, was where there were works partially completed at the date of appointment. So they might have been midway through a construction project, but in order to sort of fulfill that contract and issue progress claims, the administrators are required to undertake further works in order to sort of finalise the matter and submit a progress claim in accordance with the contract. The court actually found that was a non-circulating asset, and so by its very nature, that sort of suited the secured creditors as, you know, the other ranking, like for example, priority creditors, employees, and the VA's indemnity didn't apply to this category of work. Then there was two other categories that the court elected not to make a direction in relation to, predominantly because there was actually none of this. It was more a theoretical issue that the administrators wanted to raise, and that was where there was a contract on foot, but they either hadn't commenced work or actually hadn't been given a specific order for the work. So that was still sort of up in the air, but it's not often that we would come across that sort of thing. So the first three categories there are the interesting ones, and they're, you know, what we would fairly regularly see in an appointment is, you know, for a business that's involved in making something or providing services on an ongoing basis, there you'll often have WIP and WIP in different stages. So just another consideration that is sort of quite topical and interesting. I'm going to pass over to Ben now to talk through PPSR.
Thanks, Jeff. One of my favourite topics. So hopefully it's not news to anyone here that the PPSR is a thing. Personal Property Securities Register, set up under the Personal Property Securities Act. So it's been in force since 2012. Transitional provisions finished in 2014, I think. So you know, we're well and truly into this, but it's still an area that can trip everyone up, and it's still an area that we find some relatively fertile ground for working through defective claims. So I'm going to start first with order of priorities on this slide because I feel like it makes a little bit more sense to start there. So Personal Property Securities Act set up a system of priorities. So recognising that the commercial reality of the world is that different financiers will be involved in different stages, and trying to provide a framework to have that make sense. So this was in response to an idea that there was just horrendous lack of transparency from people, because you could have a security interest just written on the bottom of your invoice. So to try and move more towards a system that land titles has, PPS came up. So order of priorities, the default position is that a perfected interest defeats an unperfected interest, and first in time works out in a class. So if it's perfected and I was before you over the same class of collateral, I would win out. And same if we were both unperfected. So that's the base situation, but that didn't address the reality that if I'm kicking off a new venture today, one of the first calls that I'm going to make is to one of the people on this call trying to get myself some finance. So if I was a stock supplier thereafter, all of my suppliers would be after the bank, and therefore I would be providing collateral that would ultimately enrich the bank ahead of me. So they created this amazingly well-phrased and well-labelled instrument called a Purchase Money Security Interest, or a PMSI. And that gets a super priority over the relevant asset that it's applied to. So most commonly seen in the context of inventory. So again, in the context of how does this affect you all as bankers, it's just that recognition that, yep, we might have our GSA in place and that covers the stock, but just remembering when you're assessing how much you're likely to get out of it, that there are likely going to be suppliers that have valid registered purchase money security interests, and they may need to get assessed. And there's traps with your purchase money security interests. They can be as defective as any other instrument, and it's important that they're registered on the register prior to the relevant supply. So if you've done your search and you've seen that Ben Pty Ltd has a PMSI over stock, but it was registered only yesterday, if I'd supplied that stock earlier, it's not necessarily covered. So it's a trap for new players, and it's certainly one that we have to be aware of when we're assessing these. Security over specific assets. So with the PPSR came a shift away from fixed and floating. It became circulating and non-circulating. So as financiers, it's often the case that you will register over specific assets. Another thing that we see from time to time is, you don't necessarily have to register over specific assets all the time. Sometimes it's you may, but I think it would always be prudent where possible to try and register both against the grantor, so the relevant debtor, and also the relevant asset, because there's a hypothetical scenario where I finance an asset off of you, and then I lease it on to Jeff, and Jeff goes belly up for whatever reason, and the liquidator over Jeff Co comes along and goes, okay, cool, that's my asset, there was no registration against it, thank you very much. And then you're sitting there looking at me going, hey mate, what the heck, why didn't you perfect our interest? And we're all out of pocket all of a sudden. I've got to pay you for an asset that a liquidator sold. So I think in terms of being prudent, registering more is probably better than registering less. Ensuring that security interests are registered correctly. As we've said throughout this, defects happen, and defects can be fatal. So if they're a specific defect as set out in the Act, or if they're seriously misleading, they can be defective as if they're not even there, so it becomes an unperfected security interest, and unperfected security interests in an insolvency event will vest in the liquidator. So all of a sudden you've gone from top of the pile to an unsecured claim alongside everyone else. So common mistakes that we see there, particularly with respect of trust assets, often we'll find that registrations are against the corporate trustees ACN. The PPS sets out a priority of, what type of entity is the grantor, and therefore you start at the top and you work your way down. So if it's a company, yep, ACN, happy days. But if it's a trust, it needs to be the trust's ABN, not the corporate trustees ACN. So if you miss that, again, it's defective and out the door. And then like the other big ones that we see, just like typographical issues. So ones and T's or I's, zeros and O's, these sorts of things that if someone goes in and you've only registered against a vehicle and you've done the right thing and it's the VIN, but you've given the wrong VIN, that can be seriously misleading, because it just needs to be whether a registration would be disclosed if I search the correct level of identifier. So that's a real trap. In addition to the unperfected security interests, if you're late to register, so that can still be okay as a security. You might postpone yourself behind someone that gets in the interim. But if we come along within 6 months of that, then all of a sudden that can become our asset as well. So that's another trap. And tracing provision. So we've mentioned a couple of times that cash is cool and cash is great. But if you had a perfected security interest against an asset and that's being sold and turned into cash, the PPS allows you to trace from that asset sale into the cash. That's inherently going to be a difficult proposition and potentially quite costly, where it's not just a clear-cut case of 20 grand sold, 20 grand in, and that 20 grand still there at the end. But you've certainly got the right to make inquiries about that. So that's a quick tour through the PPS. We'll move on to some specific examples and industries.
Thanks, Ben. So first industry, we've got sort of 10 minutes, a bit less than 10 minutes left here. So we'll just run through some sort of topical issues we see fairly commonly in a couple of key industries where I suspect a lot of you on this webinar will have some sort of exposure or experience. Retail industry, obviously very heavy on stock, heavy on cash management. So the key, we've talked about it a number of times, but the retention of title that suppliers have, again, it's an issue for them to register on the PPSR. Based on our experience, I'd say it's a pretty mixed bag of suppliers, whether they actually understand the PPSR or not, and whether they register correctly. The big sort of differentiator that I've seen a number of times is that the local suppliers tend to get it and tend to understand PPSR and at least get some sort of registration to try and protect their retention of title claims. Overseas suppliers, it's pretty rare to see, overseas suppliers who have provided goods actually registering on the PPSR. So it can be a bit of a windfall in an administration. You might have, a company importing a lot of their stock, and once the appointment happens, the overseas suppliers might try to claim retention of title, but have no idea what we're talking about when we mention PPSR or security interests or anything like that. The other issues we see, often retailers operate out of leased premises, and dealing with a landlord to secure assets can be difficult. Whilst an administrator gets sort of a right or a bit of a moratorium, I guess, from landlords taking action, in practice, that's not always how it goes. So, as administrators, we need to act quickly and work closely with landlords to get them on side. Again, we've mentioned it a few times now, but the for sale value of stock, forget about any sort of margins that an ordinary retailer trading in the ordinary course would charge on stock. We're talking usually cents in the dollar on cost value of stock. So it's typically a heavy write down when you're looking at a liquidation of stock. Cash management and cash handling, I guess it's becoming less and less of an issue as we're all tap and go and paying on card and these things these days. But there's still opportunities within the retail environment for cash to go to not necessarily find its way into the till and then into the bank. So I guess it's just good to understand your clients, what their cash management policies and procedures are, and how well that's managed. And guys, did you have anything else you wanted to add on retail, Matt or Ben?
I'll just see, in terms of current risks, they're obviously front of mind when it comes to industries that have been impacted by lockdowns. And so invariably there'll be some battling clients out there, and they're still at risk of those snap lockdowns that we're seeing around the country. But perhaps the even greater risk is now, as we see a lot of the relief being peeled back, where these struggling businesses such as retail, they'll stop getting their financial benefits from the government, such as JobKeeper, for example. And so that will happen quite quickly now, and so all of a sudden those cash flow issues will come to the fore. And then what coincides with that is that creditors that weren't able to pursue debts and enforce by way of wind-up application, they weren't able to do that as quickly as they normally would, needing a 6-month lead time. Well, that's since changed and it's back to normal. So those sorts of trade creditors can now apply to wind up a company after issuing their statutory debt demand with a 3-week lead time. So I think retail's, if we're going to talk about risks, is probably quite apparent that there's a lot of risk there for financiers. And then with that changing landscape of that legislation there all happening right about now, it's something to keep an eye on. Yeah.
Thanks, Matt. The next sort of very broad brush industry, but typically any business providing services. So, we're talking engineering, professional services, those sort of things. As we highlight in that RCR case, the value of WIP and how you actually get your head around, what is actually sitting on the balance sheet, what's not on the balance sheet, whether, you have first rights to it as a non-circulating, or whether it is considered a circulating asset. The key thing we would look at when appointed to a service-based company is how are we actually going to be able to convert that WIP into a receivable to then turn into cash. And that often involves finishing off some sort of project or complying with our side of the contract to finish that off. So it's then a bit of a cost-benefit analysis to determine whether it's worthwhile spending X amount of money to finalise a contract to then be able to bill, rather than walking away from a half-finished project where you've got no chance of recovering the WIP that's sitting on the balance sheet. You'll often see in these industries contractual claims and rights are set off for whether it be liquidated damages or unfinished work or rectification or that sort of thing. And believe me, creditors will absolutely try it on. Sorry, debtors will absolutely try it on when they see an administrator appointed, in terms of claims of set off and that sort of thing. So we're forever dealing with particular claims under contracts to try and get out of paying what they're legally required to pay. And there's often a lot of commercial discussions and negotiations around that point. And then, once, if you have been able to convert the WIP into debtors, or there's existing debtors there, what processes you're going through to collect those debtors to maximise the circulating assets. And the last sort of 1 or 2 minutes, the last industry we thought we'd touch on is manufacturing. And obviously, generally a capital-intensive business, so you'll often have funded equipment or machinery or goods sitting there. So look, whilst it's great to have an asset that you can physically point to and sell, we need to consider what the second-hand market's like for that equipment, whether there's benefit in sending it offshore or running going concern sales, or whether it's just worthwhile sort of trying to liquidate the asset via an auction or similar process. Other issues you see in manufacturing, tracing, again, it's a very difficult one for someone to claim, for a creditor to claim tracing. So basically it allows, the theory is that if they've got a security interest over, for example, they might have supplied a certain component that went into a machine that was manufactured, and then that machine was sold and the cash came in. The theory is that they could trace through, you know, the cost or the money that they're owed for supplying that component, they could trace through to the cash. But the actual you know, effort it takes to trace that through often outweighs the benefit to them. But it's something to be mindful of. It sort of certainly exists in that industry. Not many creditors are aware of the tracing provisions, but they're there, and some have tried it on in the past and will continue to try it on. It's just a very difficult thing for them to do. And finally, again, we'll see it in this industry, what constitutes inventory, whether it's you know, you've got WIP or finished goods or components sitting on a shelf waiting to be turned into inventory. How do you classify it, and whether it's you know, non-circulating and available straight to secure creditor, or if it's circulating and has to go through the priority waterfall. And with that, I'll hand over to Matt to wrap up.
If I take my mic off mute. So we've just hit our time limit, so I'm conscious that attendees might have other things to do, but whilst it's quite a simple topic, priority creditors by description, I think you can see that there's quite a lot of complexities to consider. I hope that we've provided a lot of clarity for you today. Rather than going through some questions and answers, I might take those offline. But what I will do, just because of this time limit here, but what I will do is encourage anybody on the call that has any questions to just reach out to us. Our phone numbers are there. As you can see, we're friendly people, so more than happy to help with a call and any off-the-cuff questions that you might have. So feel free to contact us. Thanks, everyone.
Thank you, everyone. Have a good day.